In Chapter 5, we're going to talk about the time value of money. And the time value of money is one of those fundamental concepts that applies to both finance and the accounting world. In accounting, we use it for leases, for bonds, for pension plans, and for the present value of a liability, which we are allowed to present the present value instead of the full liability if it's far enough in the future. We also use it for AROs, which is asset retirement obligations. And so time value of money is a very, very important concept to us. And what it basically, the idea is you can take a dollar either today or at some point in the future and find out what it's worth. Either, let's take a dollar today, how much it'll be worth in 10 years. Or you can take, I need so much money in 10 years, how much do I have to invest today in order to get that? So when we're looking at this, you can kind of think of it as the basic structure of the time value of money as a 2x3 matrix. Okay, so on the 2 side, you have either the present value or the future value, right? With the present value, we take some value in the future, and we want to know what it's worth today. With the future value, we take some value today and want to know what it'll be worth at some point in the future. So they're kind of the inverse of each other on that. And as a matter of fact, you can, if you know the table of one, you can create the table of the other just by a little bit of algebra on that. And then, so that's the 2, the present value or future value. And then across the top, on the 3 side, you have either a lump sum, so it's going to be a fixed dollar amount either today or in the future, or you have one of 2 types of annuities. You have an ordinary annuity, and then you have an annuity due. Now let me explain, first of all, explain what an annuity is, and then the difference between an ordinary annuity and an annuity due. Okay, so for an annuity, for our purposes, is nothing more than a stream of constant payments. So I'm going to give you $5,000 a year every January 1st of each year for the next 10 years. That would be an annuity. You're going to pay a flat amount of money, like a mortgage. A dollar, or you're going to pay so much, $1,000 every month for the next 30 years. That's an annuity, And so it's just a set stream of money that comes across each and every period of time. Could be a year, could be a quarter, could be a month, whatever it would be. Now, so that's an annuity. The difference between an ordinary annuity and an annuity due is that with an ordinary annuity, the payment comes at the end of each period. So it would be at the end of a year. Whereas with an annuity due, the payment comes at the beginning of the period. So let's say that you earn a salary. That would be an annuity where you get paid at the end of every month. You go to work for a month or you go to work for 2 weeks, and they pay you a set amount every month. Is what you would get. That would be an ordinary annuity. On the other hand, an annuity due is like if you're going to lease a car. You're going to put down $1,000 today or $350 today, and you'll pay $350 every month for the term of the lease, probably 3 years. That is an annuity due. The payment comes at the beginning of the period of time. And so the difference between an ordinary annuity and an annuity due is just 1 year, 1 period time difference on that. Okay, so on this, on these, the present value factor, you can use tables to do this. We can also do it in the modern world. We can do it on Excel spreadsheets. We can do it in a financial calculator. tables are handy. They're in your book, and I kind of like students to learn based on tables because you can see the relationship between time and interest rates on these tables. And so in the back of your book, there are 6 tables. The first one, here's a picture of it. Can't really see it too good. It's a little blurry there, but it is table 1, and it is the present value, or this is actually the future value of $1. And so in this case, let's say that I have $100 that I want to invest for 10 years, and I can get 8% interest. So I would go down to my chart to 8% and down 10 years, and I would see that the present or the future value factor is 2.15892. So I take that factor, 2.15892, and I multiply it times the $100 that I would invest. And so that means that at the end of 10 years at 8% interest, I would have $215.89. Okay, so, and we can see if I go up an interest rate to 9%, that would be 2.36 or $236. And if I went down 1% to 7%, I would get 196 is the factor, or $196. And so you can see the relationship there on the table. The next table that we have is the present value. And so somebody's going to pay you $1,000 10 years from now, and your discount rate is 8%. We'll use that again. And then you'll look on this table, 10 periods at 8%, and the factor is 0.46319. Okay, so 0.46319 times the $1,000 they're going to pay you. If 8% was a legitimate interest rate for you, you would be indifferent between receiving $463.19 today or $1,000 10 years from now. And so that's how we use the present value table. You can also use it in a reverse manner. So let's say that you have a boss, and the boss says, I only want to do this about 10 more years, and you seem to like what you're doing. If you can come up with $100,000 10 years from now, I will sell you the business for that. So how much do you need to invest today in order to get that $100,000? Well, if you can invest in the stock market at 9% for 10 years, the factor will be 0.4224. And so if you could come up with $42,241 today to invest in the stock market, you should have, at a 9% rate of return, the $100,000 at the end of 10 years. You can also do it the other way. You can find out what you need. Let's say that you have $30,000 now, and you need $100,000 in 10 years. So you know that is 0.3. So you would look across the line, and you would see that 12% is 0.32. So you would need a little bit more, like 13%. The table we have here jumps from 12% to 20%. And so you would need a little more than 12%, so probably 13% rate of return in order to come up, if you had $30,000 now, to come up with $100,000 in 10 years. So that's how you can use these. You can do the same things with annuities. You have the present value and the future value. The difference on an annuity, however, whether it's an annuity due or an ordinary annuity, is that the numbers will increase as you go up instead of decrease. And the reason for that is, remember, you're getting a payment every period. And so with the lump sum, you only have one payment at the very beginning. Now with an annuity, it's how much do I have to put in every period, or how much will it be worth if I invest that every period. And so when we go up a period, the numbers will increase because we're getting one extra payment as we go on. Now, because of the time value of money, the further out we get in time, the numbers don't increase as fast, right? $100 a year from now is worth more than $100 10 years from now, right? And so so we can use that present value on that. Honestly, I think this is one of those chapters where where my demonstrating the various problems as we go through here will probably be more valuable to you, and so I will get on those in the next couple of days, and so you'll have examples of how to use the present value factors, was present value, future value tables, and how to use those. All right, so that's a brief introduction to the time value of money, and we will see you later.